only 25% would trade a naked put.
Mm-hmm.
Why is that interesting, Mike?
Well, they're parity trades of one another. They're essentially the same risk-reward profile, a covered call and a naked put.
Yeah, the a naked put is essentially the same as a covered call with this one important difference, okay? With a covered call, you buy the stock first. With naked put, you're forced to buy the stock if it goes against you.
Mm-hmm.
Okay, but it's exactly the same risk. It's exactly the same risk. Okay, so that to me suggests a lack of understanding in the general marketplace. I mean, why shouldn't it be 63% do covered calls and 63% also do naked puts?
Well,
It's the same trade.
Yeah, but part of it could be not their fault. It could be because of their broker, for example. Because I know my broker, Fidelity, you have to specifically keep applying and applying to trade naked puts in a retirement account, even though you're allowed to trade covered calls. So they make it more difficult.
Interesting?
Yeah, they make it more difficult for us to trade those.
How about that? Well, let's talk about these spread traders. Okay, 65% say that they do spreads. We're going to look at some spreads that defy the conventional wisdom. Okay, and we're going to also look at some spread trades that actually don't depend on you being able to predict where your stock is going. Okay, so I think folks are going to be excited with that. The radioactive profit machine is an income-producing asset. So the old analogy was, okay, cover call selling is like you own a house, and the house is your stock, and you rent it out. You rent it out by selling calls. Well, I don't know about that. I think that it's more like a business, okay? And a business has insurance. It has defined expenses. It has projected income, and it has deliverables. It has receivables, okay? The way that I like to treat a radioactive profit machine is like a short-term small business venture. Okay, I've had a number of small business ventures. One of them is still in existence. My martial arts studio that I started 23 years ago. I'm still punching and kicking. Today at 4:30, I'll be knee deep in 6-year-olds. You know, it's a fun profession for me. Okay, but I've learned how to use all of the different instruments, not just buy something and hope that it sells for more than I bought it. Okay, here's Southwestern. Okay, Southwestern I got into February 11th of 08. We're going to show a really good example of an income method number 6 trade, but more importantly, the management of it. Okay. At the same time, I bought a $70 put option. Now that's 7 months out in time, isn't it? Or a little more than 7 months out.
That's right.
Okay. Yeah, because September is the 9th month, okay, and February is the 2nd month. So it's 7 months out, and I buy it for $13. So our total investment here is $73.95. I'm guaranteed to get $70 of that back. Okay, so my at-risk amount is the difference, $3.95 a share, or about 5.34%.
Kurt,
now, that's,
can I pause you just for a second? We had a couple of questions come in from the maybe the 3% that answered options me no likey, who were asking what is a married put, and I've been answering them, but I just want to take this example. In a married put position, what I'm going to do is I'm going to buy shares of stock that I think are going to be moving up in price, but at the same time, and in this example in SWN, I'm going to buy a put option that acts as insurance. So my total cost in, as Kurt just showed us, is the price of the stock that I purchased plus the price of the put, and the put gives me the ability to sell to close the position at any time at that strike, so I only have this limited amount. This is a married put setup, long stock plus long the put.
very good. In a recent seminar, I had folks in the room raise their hand if they had insurance on their car. Everybody raised their hand. I said, okay, now who has insurance on their house? And everybody raised their hand. And then I said, now who has insurance on their stocks? And like, 1 or 2 people raised their hand because they knew what I was talking about. Okay? And a lot of folks raised their hand. I thought to myself, oh, wait a minute. What's more likely to burn down?
Right.
Your house or your stocks? We know the answer to that. We've seen that over the last few months. Okay, and yet everybody that's a critic of mine seems to say that, oh, insurance is expensive. Well, we're going to prove later on. I'm going to actually show how insurance, the insurance of a put, actually brought me some money. It actually brought me money by manipulating the insurance policy. But for now, let's look at income method 6. Okay, so I have $3.95 at risk in this married put position. Okay? And 2 weeks later, I sold to open an April $70 call. So for you options me no likey folks, okay, what I've done is I've sold someone else the privilege of locking in a $70 price. If the stock goes to, 80 bucks, well, they get to buy it for 70, and they've paid a small premium for that. What they paid me was $3.90. Well, let's think about something here. I've got $3.95 at risk. I sold a call for $3.90. What's my new at-risk amount?
A nickel.
A nickel. I've got a nickel per share at risk. Now, let's say in April the stock is higher than $70, and whoever I sold that to, they exercise their right. So I get to keep this $3.90. I get $70 for the stock, so that's $73.90, and I spent $73.95. So it sounds like I've lost that nickel, doesn't it?
That's right. That looks like it.
Okay, but what have we forgotten? I still own something.
That's right. Yeah, I said you still had several months left to expiration, or at least a few months left to expiration on that put option. It's still going to be worth something. It's going to be worth more than a nickel.
Right. So I'll have all but a nickel of my investment back, plus own a put option that's worth probably several $100s. Okay. So at this point, I am essentially bulletproof. That means I can't lose any money. Okay. Well, that I haven't shown you anything new. Okay. That was income method number 1, selling a covered call. So here's what happens, okay? I hold on to this for about a month, okay? And then Southwestern takes a one-day dip, kind of like that one-day dip I told you about with Energizer.
That's right.
It takes a one-day dip, and I said, you know what? That April $70 call that I sold for $3.90, now it's cheap. I can buy it for $1, and I did, okay? So I have a nickel at risk. I put another $1 in, okay? What do I now have? A risk of $1.05. Yeah, now that's per share, so what's the true dollar amount there, Mike?
It's $105 because you only had 100 shares, right?
Right.
Okay.
So 105 out of the $73.95 that I invested at the beginning is at risk. Now, I'd like to say that if 5.34% risk was good before, is 1.42% risk okay? See, that's how I still, yeah.
Yeah.
Can you imagine setting a stop order that says, man, if that stock dips by more than 1 and 0.42%, if it dips by more than 1.5%, get me out. If you set a stop order like that, what's likely to happen?
I'm going to get closed out in the first minute, 2 minutes of trading, if I'm lucky.
Right.
Might be 10 seconds.
Right. Okay. On the other hand, I have a legal and binding contract that says that I can sell it at a 1.42% loss, but I have unlimited upside. Well, now with that situation, okay, here's what happens the next day. The next day the stock goes up again, and I'm thinking, okay, it's time to sell calls again. But you know what? Instead of selling a covered call, I'm going to sell a bear call spread. Okay? Now, folks out there that understand spreads, it looks like we had 65% of our audience does spreads.
That's right.
Okay. What's the good thing about a bear call spread, Mike?
Well, we collect a premium up front, and as long as the stock remains below the strike price of the call that we sold, both options will expire worthless, and we will keep the premium.
Right. Now, I did this particular income method because the stock was trading right at 70, and according to 2 of our rules, okay, called the ATM bell curve and the red line graph.
That's right.
Which we can't discuss right here now, but they're in the blueprints and they're also in the seminar, okay?
Yes.
Because of those principles, I chose this income method. I used income method 6, and I sold to open the May $70 call for $276. Now, I want everybody to remember that. If I was just doing plain vanilla covered calls and just selling calls against my stock in hopes of, bringing in some money, okay, all I could get out of it was $276. Now, let's remember that figure. But what I did instead was do a bear call spread. So I brought in the $276, but I also spent $151. There's a net credit there of $1.25. Now, Mike, I asked you a moment ago, what is the good thing about a bear call spread? And you said, well, you take money up front. What's the bad thing about a bear call spread?
Well, the bad thing about a bear call spread is that if the stock moves up above the highest call price, you're going to lose money on the position. You're going to have forced to close both options and take a loss.
Right. Essentially, I'm going to be forced to deliver stock at 70, and I have to go out and buy it at 75. Okay, so that's a $5 per contract loss.